it's 12 months of your expenses, 20% of your assets in gold and 80% in equity.
Yeah.
And I was interested in this. I was going to ask you about this, Ajit, because 20% is a sizable amount to hold, and it is in fact more than a lot of personal finance advisors would say. They say on an average 10% of your assets can be in gold. You can have fixed income as well. Why do you say 20%?
So let me go back on the math of that, right? Because it's 12 months expense. So let's say I've got 1 crore to invest and my monthly expenditures are 1 lakh a month, okay? And I want to keep 12 months money aside. So that's 12 lakhs of rupees gone. So out of 1 crore, there's now 88 lakhs left. And 88 lakhs is to go 20% into gold and 80% into equity. And within equity, Quantum has built a solution where we even give you a pass-through through a quantum equity fund of funds to invest in other fund houses.
Okay.
So there are 400 equity funds out there. We're telling you, we know value, we know ESG, give us a portion of that 80, but a chunk of that 80 is going to equity fund of funds where we pick the best fund houses from the 400 out there or 300 equity funds out there. They've got 10 funds, 10 offerings in that, mid cap, small cap, flexi cap, growth, whatever it is, things that we don't know and things that we don't understand or do. We've chosen those for you. But to go back to the 20% of gold, so 20% of the 88 lakhs that's left, if you will, in the math that you've just done, is about 18 lakhs, roughly. So 18 lakhs on a 1 crore basis, in this example, works out to 18% as opposed to the 10 that you say. So the reason we've got that number is that gold is the only asset that's available in India, which you can buy in rupees, but is priced in dollars.
Right.
So the price of gold is not influenced by what happens in India. It's influenced by what's happening in the world market in dollars. Now the dollar and the rupee, if you look at the equation from 1980 till now, over the last 40 years plus, the Indian rupee has lost nearly 3% per annum on average against the US dollar. So if the price of gold was to remain steady and not change, you can assume that the price in Indian rupees will go up by 3% every year because the exchange rate will have changed.
Right.
And the price of gold goes up by 4% or 5% every year in dollar terms, you get 8% return in India, right? In rupee terms. That's why we tell you, put it in gold, because most Indians, many Indians, will either have a desire to send their children to study abroad, which means they'll have a dollar cost or a pound cost in the future. Well, they have a dollar asset in their hand, which is gold.
So it's a hedge. It's a hedge, essentially.
It's a hedge. Now, of course, there are international funds you can buy. You can buy stock, but keep in mind that it becomes again volatility and risk. The volatility of a share, you may want your children to study in a particular year. If global markets are down that year, you're in trouble. It can also happen to gold, but gold is not going to plummet the way it can happen for stocks. Not that sharply.